Hi everyone, thanks for joining. We're just going to give it a minute while all the participants slowly join. So just bear with us for about another 30 seconds and then we'll launch into our investment webinar and a bit of an update on how the markets are going and a bit of an insight into the portfolio. So it shouldn't be too much longer. Okay, well, I think we might get started. So I'd like to welcome everyone to our investment webinar today. My name is Michael Bova, and I'm the founder and managing director of Family Wealth Advisory, where our vision is to help families live a magnificent life. Now, in the spirit of reconciliation, I would like to acknowledge the traditional custodians of country throughout Australia and their connections to land, waters and community. Pay respect to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples, the Maori peoples of New Zealand and the Indigenous peoples of countries where people joining us today for today's meeting live and work. Now, this year has seen unprecedented market volatility, increased geopolitical tensions, rising inflation, rising interest rates, resulting in negative returns in bond markets, something we haven't seen to this extent since 1994. So investors have had to manage both falling share prices and falling bond prices at the same time, resulting in a very challenging 12 months. So I'm excited to be able to bring a panel of experts together for our discussion today, where we'll unpack these topics and discuss the year that was and what we can expect moving forward, and hopefully provide you with some invaluable insights. Now, I'm joined today by our investment manager, Mercer, and two of our portfolio managers, Janus Henderson and PIMCO. Now, in the new year, we'll continue to keep providing these webinars for our clients, Mercer always providing the portfolio construction and market overview, and we will invite some of the portfolio managers within the Family Wealth managed portfolio to provide some of their expert overview in terms of how they manage money for our clients. Now, today's session is being recorded and a copy will be emailed out to you afterwards. And I would like to thank our panelists for their participation in our session today. Mercer is going to lead us off, providing a market overview, which will be followed by a panel discussion. Now, Mercer are a global asset management firm that operates in over 20 countries with 25,000 employees, combining global and local expertise, perspectives and solutions. They're an investment specialist in capital markets, manager research, portfolio construction, responsible investment and investment governance. Mercer will also provide some insights on how they help build portfolios for our clients and how this portfolio construction addresses the current market challenges. Joining us today from Mercer is Rebecca Jacques. Rebecca joined Mercer in 2018 as Head of Portfolio Solutions for Wealth Management. Over 25 years experience in financial services with expertise in preparing strategic investment advice for wealth and institutional clients. She has a deep understanding of portfolio construction, manager research and managed funds. She holds a Bachelor of Arts in Economics and Politics with honours from Monash University and a graduate diploma in Applied Finance and Investments from the Securities Institute of Australia. You're really going to enjoy listening to Rebecca. She's very knowledgeable and full of energy. And joining Rebecca, we have Jay Sivapalan from Janus Henderson Investors, who is the head of Australian Fixed Interest and a portfolio manager looking after Australian fixed interests, so quite timely. His responsibilities include formulating interest rate and sector strategies employed within the portfolios, working closely with key fixed interest clients. Jay joined Janus Henderson in 2015 as part of the acquisition of Perennial Fixed Interest. He joined Perennial in 2001, initially heading quantitative area before transitioning to the Australian Fixed Interest team in 2004. So quite an extensive amount of experience. Jay earned a Bachelor of Commerce degree in Actuarial and Finance in the University of Melbourne, and he holds a Chartered Financial Analyst designation and has 24 years experience. We are also finally joined by Manusha Samarawira from PIMCO. He is a Vice President and Product Strategist at PIMCO's Sydney office. Manusha is primarily responsible for management and development of PIMCO's Australian strategy offerings. He works in PIMCO's Australian research, consultants and product group, servicing research-related clients and consultants. He joined PIMCO in 2011 and held roles in both institutional and global wealth management. 11 years of investment and financial services experience, and holds an undergraduate degrees in commerce, finance and laws at the University of Sydney. So thank you very much to all the panelists for joining us today. Now, to anyone who's watching today's investment webinar, there is a Q&A section down the bottom. Please do put any questions there. And when we get to the end of today's session, we'll try to answer as many of those questions as possible. So now I would like to hand over to Rebecca from Mercer to lead us off. Thanks, Rebecca.
Thank you, Michael. So look, let me just I'll give you a quick 5-minute update on where we're sitting. Obviously, the world is not an easy place to exist in at the moment with the way financial markets have been behaving. You know, we're coming into the tail end of November and we're hoping to see some slightly better numbers, but it's still not looking promising. I think the biggest thing to take away from this chart is if you look at the dark blue sort of bars, they are the 12 months to the end of October 2022. And really what it shows you is effectively there's been nowhere to hide, right? Outside of, say, direct property, which again, we have to be mindful, it does not have the same level of transparency in terms of market valuations that we would expect to see in listed assets. So we do acknowledge that those numbers will sort of come down a little bit. It is pleasing to see that we are starting to see a little bit of a reversal in some of the numbers, particularly on the equity side of the equation. But I think, you know, and one of the focuses that Michael and the panelists have thought about today is really focusing on that defensive part of the portfolio and sort of looking at why have we experienced the type of returns that we have. It is, you know, the best way to describe it, unfortunately, is that we've probably returned to a normalized period in financial markets because we've actually really been essentially in an abnormal era. And you can argue that that abnormal era really started way back in 87 with Greenspan, right? You know, so, and the view that we sit in now is obviously a world where inflationary pressures are very much front and center of the table. They are being exacerbated by certain geopolitical tensions, which are also compounding some of the supply side shocks, all of which are adding to inflationary pressures. And also effectively a global economy where, you know, growth is going to be weak over the sort of foreseeable few quarters at the very least, if not sort of medium-term outlook. So what we're going to do today, I know, Michael, I think you're going to run the Q&A sessions, and we're really going to talk through this sort of period of inflation, the role of fixed interest and its defensive nature and when that returns. And then we'll have a look right at the end. Michael and myself will go through, you know, sort of some of the positionings that we've done in the portfolio most recently to try and help, you know, prepare the portfolio for the inflationary environment and the uncertainty that I think is very much on the landscape. So, Michael, I might hand back to you at that point and let you start with the questions.
Great. Thanks, Rebecca. Thanks for the macroeconomic overview. So what we'd like to do now is just go into more of our Q&A discussion part of the investment webinar. We'll be reaching out to our panel experts to get their insight. And as I said, please do raise any questions, but I'll sort of start us off. So I think the front of everyone's mind is rising inflation and the concerns that that's been having both in terms of personal experience, but also in terms of the financial market. So Manusha, can you comment on this? And also, why did bonds do so poorly during the year if it was sort of already priced into the market? And does this mean that fixed interest is not going to play a defensive role in portfolios going forward?
Yes, so just to start off with, thanks for having us here. We very much appreciate the time you've given us to present today. Appreciate it's obviously a very busy part of the year as well, so very much appreciate your time. So I guess the starting point is we actually believe that the defensive role of fixed income is, if you like, more pronounced today than it really has been for quite a number of years. And really, we believe this for a couple of key reasons. So first of all, the yields that bonds offer today are really much higher today than we've seen for quite a number of years, which means we ultimately believe that bonds are now set to provide returns more in line with what they've returned in kind of longer term averages, rather than the fairly low returns we've seen from the asset class in the most recent years. We also think that core high quality bonds should act as a better diversifier in broader multi-asset portfolios. So keep in mind, one of the key reasons that you hold bonds in portfolios in the first place is really that they're supposed to be a diversifier amongst a multi-asset portfolio, to perform well when those things in your portfolios like equities and property and infrastructure, for example, when they're not doing so well, that allocation to core fixed interest is supposed to be doing relatively well. So now that yields are higher, they ultimately have further room to fall in the event that we do see those kind of market volatile periods, which ultimately should fuel positive bond prices and bond returns during that period of time. So I guess the quick answer to your question is that we ultimately do believe that the role of bonds in portfolios really remains true today, and arguably the case is stronger than we've seen in the most recent years. I guess on the earlier part of your question on, if you like, why fixed income has done so poorly this year. So I guess heading into this year, it is true that bond markets were pricing in some expectation for higher inflation and higher central bank policy rates, but markets were really just not expecting the magnitude of the increases in both inflation and cash rates that really have played out over the course of this year. There have been a couple of additional unanticipated drivers of this higher inflation, including the conflict of Ukraine and also the extended supply shortages that we've seen over the course of the last 12 months or so. And this ultimately has forced the hand of central banks to increase interest rates far beyond not just the market's expectations at the early part of this year, but also the central bank's own expectations themselves. It was less than 12 months ago that our very own RBA was indicating that cash rates wouldn't really increase until 2024, and yet here we are. They've increased cash rates by 275 basis points this year. So this surprise factor that we've seen in inflation this year is really what has caused bond prices to move the way they have. Maybe one more thing I'll quickly mention here is that it's really important to remember that while bonds have had a poor performance year this year, investors haven't lost capital in investing in high quality bonds. It's purely been a price move as a result of these increasing interest rates, this increasing interest rate dynamic that we've seen that's played out over the course of this year. So for those patient investors in the core high quality bond space, you should see your prices recover back to par as these securities get closer to maturity.
Yeah, that's great. Thanks, Manisha. Yeah, I think it was a very difficult day for our central bank governor yesterday in front of the Senate Estimates Committee. So I think you're right. I think it caught everyone by surprise. So I think in summary, you're saying a bit of short-term pain in the bond prices, but much stronger incomes washing through, which I think our investors would be very happy about. Jay, did you have anything to add to Manisha's comments there in terms of inflation, direction of inflation?
Yeah, thanks, Michael, and thank you everyone for the opportunity to speak this afternoon. Manisha really covered it quite well in terms of what's been happening in the bond market. But if I can just take a moment and a really big step back and really put 100-year type of context to this bond market. Rebecca in her opening remarks really hit the nail on the head in that the period that we're exiting is more the aberration than the norm. I think when we look back in history, and history books are written in 5 or 10 or 15 years' time, someone will say, oh, these negative bond yields that they experimented with in Europe, what a silly idea that was. And so, that is really the environment that we're exiting. Now, in the context of the last 100 years, there's only been 4 times when both the equity market and bond markets have fallen together. And they've generally been very crudely about 30 years apart. So I guess the first thing to say is that Yes, bond markets have had a poor start this year, and Manisha provided some reasons as to why that was the case. But I guess for investors thinking ahead, many of the defensive characteristics of fixed interest as an asset class and why investors employ fixed interest as part of a diversified balance fund or growth fund are much better today. And just to give you some color around why that is, today the Australian bond market on average is providing a yield of somewhere close to 4%. And many fixed interest products in the market, including our own, provides an all-in yield closer to 5%. So all of a sudden, investors have a 5% yield to work with. And through at least my investing career, which really started in the 90s through to the 2000 and 2010s and now, there's been at least 4 major market corrections, including the GFC, European sovereign debt crisis, prior to that, WorldCom, Enron, and prior to that, the tech bubble, when fixed interest as an asset class went up in value sharply when equity markets fell. And that's really the core reason why you have fixed interest. The GFC, for example, the Australian bond market rose by about 14.5%, when, as you know, equity markets are down some 40-odd%. So the question is, where to from here? Yes, central banks are dealing with an inflation pulse. There are 2 parts to inflation. There are structural inflationary pressures, which Rebecca touched on earlier about, geopolitical risks, the reshuffling of global trade that many countries are embarking on, the big energy transition that the globe needs to really undertake. And that's expensive. And there are some inflationary pressures that are born out of that, which are structural in nature and longer term in nature. Then, of course, there's a cyclical part, which is we had this effectively economic stop during the pandemic. Now everyone's back online again, and they want to travel and they want to eat out and they want to visit family and all the rest of it. And so we're having this cyclical inflation, which was also impacted by supply chain issues, which should recede as we go through 2023, especially given that central banks have raised rates quite a lot around the globe and in Australia, where economic growth next year should be lesser than this year, and that will create some spare capacity, especially for the labour market. So looking forward, we would suggest that a lot of the resetting from the aberrational period of negative interest rates and zero interest rates that we had over the last 2, 3, 4, 5 years, that much of that damage has been done in bond markets. Now there's a 4% for the broader market and 5% for most funds yield. That's a really good starting point to going forward. And I'll just finish with one comment, and that is that the very long-term average yield on long-term US treasuries, so US government bonds, is between 4 and 6%. And that's not too dissimilar to where they are today.
Great, thanks, Joe. So it sounds like you're saying that inflation's, if it hasn't peaked, it's at least starting to get there. Manusha, what's your view on inflation? And do you feel like it's peaking, or are we getting close? I know it's an unknown, but in terms of your analysis and PIMCO's, where do you see inflation peaking?
Yeah, so our views are actually very consistent with Jay's views just then. So ultimately, look, we're cautious to make the call on whether inflation has peaked or not, but ultimately our base case is that we think that inflation, if it hasn't peaked already, it's likely fairly close by. So we did see, obviously, a fairly softer CPI print coming out of the US just a few weeks back, but it's really important to remember that there were quite a number of components in that print, like retail spending, for example, that were particularly quite weak in that print. And because of some of the temporary seasonal factors that we're likely to see towards the end of this year, like, for example, Christmas shopping, we are expecting some of those factors to temporarily re-accelerate into the end of the year. So that's part of the reason why we are still a little bit cautious on calling the peak for inflation just for the time being. But for us, I guess the more important kind of newsprint out of that most recent US CPI number was ultimately a welcome sign that we believe that central bank actions appear to be doing what they're designed to do, which is ultimately to cool the economy in a bid to reduce that inflationary impulse. So that CPI print did appear to show signs of that. So whether we do see another peak in inflation in the US or not, we do think that there are signs that inflation should be moderating over the course of the next year or so. Even if it does moderate, we still do believe that inflation is likely to be a little bit stickier on the upper end. And we do think that inflation is probably likely to remain a little bit ahead of central bank targets for an intermediate period of time. But we do think that the level that inflation will ultimately plateau at will be much lower than the levels that we're currently seeing. And we'll start to see the benefits of that next year. Now, we do, however, expect that there's quite big disparities across regions. So it's probably important to take note of that as well. So I think I mentioned our US kind of trajectory over the course of the next 12 months or so. We think Australia's inflation trajectory looks broadly similar to the US, except perhaps maybe a few months behind, and potentially the peak is likely to be a little bit lower. But ultimately, we do think that we'll see Aussie inflation moderating from next year onwards as well. We think Europe and the UK are fairly unknowns at the moment. We could still see quite a lot more stickier inflation coming out of those regions, mainly due to food and energy costs, as well as obviously the continuing uncertainty that's resulting as a result of the conflict in Ukraine. And finally, in emerging markets, we actually think in emerging markets, we have likely seen the peak of inflation already. And that's partly to do with the fact that we've seen quite an aggressive and coordinated interest rate tightening cycle across those countries. But I guess in summary, I think it's fair to say that there's a reasonable amount of uncertainty and dispersion across regions, but we do expect some moderation in inflation over the course of the next coming months and quarters.
Okay, so we've seen a sharp rise in inflation and a sharp rise in interest rates to try and, let's say, kill inflation, and that's created a lot of bond pain. So, Jay, in terms of that, and in terms of our clients that are watching this and have seen some of that bond pain in their portfolios, what's your view in terms of that? Are we through the worst of that, do you think? And have you got any comments in terms of fixed income returns moving forward?
Yeah, sure. So certainly we feel that much of the pain in bond markets for this cycle is behind us. But it's also important on how we as professional managers on behalf of clients like yours really manage that money and navigate a policy tightening path. Now, I'll address the interest rate side for a moment, but certainly it's also worth talking about credit in that context as well. So if I can just call upon slide 9 to sort of really demonstrate this. So what we've seen to date is that, this time last year, as Manisha mentioned, we had bond yields that were effectively stuck at, below 1% for all government bonds in the Australian marketplace. Now, today, as I suggested, they're more sitting between 3 and 4%. So that is quite a considerable repricing of bond yields. And what you see on screen here are effectively the building blocks for high quality fixed interest investors. So on the top left-hand side are government bond yields. So they effectively went from not far off zero to something between 3 and 4%. The middle in blue there, that is what we call the swap spread, but it's essentially the additional funding costs that companies pay when they want to borrow money. And then the right-hand side, I've just picked an example here. Think about a major bank in Australia like Commonwealth Bank of Australia, senior bonds for a 3-year term. Today, they're effectively having to pay about 0.9% or 90 basis points to borrow money. So if you add up these 3 lines, you get the bar chart on the bottom. That is the all-in yield that an investor gets for lending money to the Commonwealth Bank of Australia on a senior basis. And you can see last year, it was between 0.3 and about 0.7%. And today it's got a 5 in front of it. So quite a materially different environment. And just like shares, where you get a dividend yield and the share price has to fall enough to wipe away all your dividend yield before you get a negative return, fixed interest is the same. We're currently got a yield to maturity comfortably in the 5s. So you need to wear through 5% of income before you get a negative return going forward. That wasn't the case 12 months ago, where your all-in yield was, let's call it 0.7 or 0.8%, and you didn't have a lot to play with. The other thing that I would just suggest is that when you think about how to manage interest rate risk, if we can just flick back to one slide before this, please. Interest rate risk needs to be managed very actively. We're still not in an environment where you can buy fixed interest as an asset class and put it in the bottom drawer and forget about it. So what you see here, in particular in the blue line, is the interest rate risk or duration that us professional managers use to effectively lock in certain levels of interest rates for investors through the portfolio. So essentially, when that blue line is high, we're effectively locking that in. And when they're low, we are moving back to more floating rate or low duration. It's the same way of thinking about a mortgage. You want to be locking in interest rates when mortgage rates are low, and you don't want to be locking in interest rates when mortgage rates are high. So this is the opposite of that as an investor. So you can see coming into 2022, virtually in this particular product, our tactical income fund, we had no interest rate risk in the portfolio, or very little. But then equally by June this year, when 10-year bond yields in Australia got above 4%, and keep in mind at the time, the Reserve Bank of Australia had a cash rate of only 0.6%, but the market was pricing in the RBA having a cash rate of close to 4.5%. So we took the assessment at that time that the market got carried away, and that was 4.5% by this Christmas, by the way, which obviously we're not going to reach. And so that was a good opportunity to lock that in for investors. And so we dialed up the duration or interest rate risk. And then once markets had calmed down, we pulled that back down. So this is one example of why it really pays to be active in fixed interest, especially as we navigate this first cycle, to Rebecca's point, first cycle from a period of aberration of ultra low cash rates and bond yields.
Thanks, Jay. And Manisha, I guess just in terms of that and the direction of interest rates, you've got anything to add there? And I guess probably more broadly, where do you see the opportunities for investors in this marketplace at the moment? And how are you sort of positioning at PIMCO, managing clients' money in that space?
Yeah, so look, I honestly couldn't agree more with Jay's comments about, first of all, on the credit side of things and kind of the level of compensation that investors are getting on investing in those higher quality assets, as well as the need to remain active on the duration front. That those are two fundamental principles that we wholeheartedly agree with. One extension to that, and maybe just to steal a quote that Rebecca made in the earlier comments as well, about seeing some level of normality coming to the markets. The other kind of a point, in addition to Jay's comments about the yield that investors are getting in, for example, Aussie dollar corporate bond senior paper today, is that when you look at the coupon yield that you get on some of these securities, so effectively the yield to maturity that you get on some of these securities today, they're actually now resemble pretty close to what you get from the same company's dividend yields today. Even on a franked basis, in some instances, you can actually see the bond yield, if not, sorry, the lights just turned off. Turns on soon. There we go. We've got energy saving in this office. ESP friendly and all that. So the distribution yield that you're getting from these yield to maturities in these bonds are actually consistent with some dividend equities that you're getting today, which is, again, something that we really haven't experienced for almost 10 years in the fixed income market, but now we're experiencing them again as kind of a normal state of play. So that gives an indication that the level of relative value in the fixed income market is returning. So I guess on a forward-looking basis, and just to kind of highlight, I guess, the kind of our forward-looking trajectory for markets and kind of our expectations, and just to your point, your question about how we're positioning portfolios. So maybe I'll just take a step back and give you a quick summary of our overall outlook, and then I can go into basically our broader positioning for markets today. But we recently conducted what we call our cyclical forum, which ultimately is a process that we run fairly frequently throughout the course of the year that ultimately tries to summarize our economic thinking for the shorter term outlook. So call it the 9 to 12 month type of outlook. And we ultimately came up with 3 broad conclusions from that most recent meeting. First of all, that recession is more likely than not across most developed markets. Secondly, that inflation is likely to be relatively sticky, but again, moderating from the current levels that we're currently seeing. And finally, that we are expecting a different paradigm when it comes to monetary policy, and that policy rates are likely to remain higher than what we've got used to in the most recent past, exactly how Jay just mentioned in his previous remarks. So I guess just to step through some of those comments in a bit more detail. So starting with the recessionary piece and speaking to kind of our expectation on a forward-looking basis, our base case is that developed markets enter into some form of recession over the next 12 months or so. And we are expecting the recession to be, if you like, a little bit longer than normal, but potentially also shallower than, for example, what we saw during the GFC. Partly the reason why we think it could potentially be a bit longer is because we think that central banks are likely to be a little bit less progressive when it comes to aggressively popping up economies during the next recession, partly because they still need to be fighting inflation at the same time. So they're going to be a little bit more reluctant to be cutting interest rates the way that they've done in the most recent past. But this could diverge quite greatly across regions. So for instance, we think Europe and the UK are more at risk of a sharper drawdown than, for example, in other markets, like, for example, Australia or the US. So that's something to keep in mind. The second point was about inflation. So I touched on this a little bit before in terms of our views, but essentially we are expecting a moderation from the current high levels that we're seeing today sometime over the next 12 months. But we do expect inflation to be a little bit higher than what central banks have got used to over the most recent past. And part of the reason for us thinking that inflation is likely to be a little bit higher than central bank targets is that there are a couple of long-term factors that we think will drive inflation, such as an example is the global energy transition that we're currently seeing from brown to green. We think that that's likely to be more inflationary than disinflationary over the kind of more immediate term. And I guess the final point here on the central bank side of things is because we expect slightly higher inflation, we don't think we will see a period of that ultra low policy rate world that Jay just described. And we're unlikely to see that for kind of the foreseeable future. And that basically meant that interest rates aren't likely to get back to the lows that we've seen. So for example, around the COVID period of time. So what does that all mean for positioning? So first of all, we are heading into this world where we are likely to see some recession in our view. So we are ultimately of the view that it's important to remain in a high quality space in the fixed income market. And we are also increasing liquidity in our portfolios as well, mainly to take advantage of opportunities as they arise. So an example of, I guess, the more defensive posture that we're taking on in our portfolios at the moment is we currently like securitized assets, particularly out of the US. We believe that the household sector in the US remains fairly strong, and therefore the bonds that are linked to those cash flows ultimately look very resilient in our eyes, even in a really negative growth scenario. Another good example of a defensive position that we've got in our portfolios is that we like the large global banks, especially the senior bonds issued by those large global banks. Ultimately, we believe that these banks are really well positioned given their very strong fundamentals following almost a decade of restructuring and de-risking of their balance sheets. The second theme of our portfolios is what we're doing on the interest rate side of things. As Jay mentioned before, we also believe that it's important to remain very active when it comes to overall positioning from an interest rate point of view. And we've been quite active over the course of this year as well, but we have most recently moved our duration positioning or our interest rate sensitive positioning in the portfolios closer to neutral relative to our benchmark. And the reason why we have done this is because when you think about what has happened from a repricing perspective of interest rates, we think that they're closer to fair in terms of valuations today. But having said this, the view needs to be very country specific. So for instance, we are very cautious on core Europe at the moment. We're also very cautious on Japan and China, as we think that these sectors, these areas of the market are susceptible to higher interest rates in a shorter space of time. The areas that we are a little bit more positive on are areas like New Zealand, where the rate markets have priced in some quite aggressive cash rate expectations, and also in some European countries, like, for example, in some of the Scandinavian countries and Switzerland. These are countries that are ultimately less reliant on global energy sources, so we could see lower inflationary impulses heading into those countries. So from an interest rate point of view, those countries look a little bit more safe to us. Finally, we remain very cautious on the more volatile sectors of the fixed income market, like, for example, emerging markets and high yield. Our view is that these sectors could demonstrate quite a bit of increased volatility in the event of a recessionary type of outcome. So I guess overall, our global and Australian portfolios, as I mentioned, are quite defensively positioned. We generally have high credit qualities in these portfolios, so they're around the AA level in terms of average credit quality. But despite that, we are still carrying a relatively attractive yield to maturity. So very consistent with Jay's comments earlier, our portfolios have yield to maturities in the 4.5% to 5% type of range, which we do consider to be quite attractive in light of, I think, what we can all agree is a relatively uncertain economic scenario.
Thanks, Manusha. So I guess in summary, are you seeing a soft or a hard landing in that scenario, or somewhere in the middle?
Yeah, so I think it's fair to say it's region dependent. So sure. I think overall we're kind of expecting more of a soft landing in most of the developed markets. Like, for example, in the US and Australia, we're expecting only a very modest recession, but potentially a prolonged one. Whereas in Europe, for example, we could see quite a bit more volatility coming out of that region. But again, to the earlier comments made, there's quite a lot of dispersion around that possibility in terms of the outcomes.
Okay. And Jay, just in terms of your portfolio positioning and opportunities you see moving forward, is there anything you'd like to add from Janus Henderson's point of view and the portfolio?
Yeah, so I might just pick up on exactly where you left off the last question, Michael, and that is about soft landing or hard landing, because that's really relevant to positioning portfolios, both within fixed income, but also outside of fixed income as an asset class, and what it really means for company earnings and tax revenue by governments. What I might do is, if I can just flick to slide 35. Now, first of all, we are in Australia close enough to a 3.5% unemployment rate. In the US, we're pretty close to that sort of number as well. So these are 50 and 70-year lows in unemployment rates. So the labour market is as strong as we've had it for, multi-generations. So that's a starting point. And absent of a left field event, a lot of the work that central banks have done in raising rates to get on top of inflation will likely mean an economic slowdown, but it shouldn't result in a disaster. So what's really key over the next 12 months is whether that unemployment rate goes from 3.5 to 4.5 or 3.5 to 7.5. Now, just starting with that, and we don't all have crystal balls, but it would be our view that the unemployment rate will probably migrate towards somewhere between 4.5 and 5%, without being exactly precise. And really, you need a left field shock to get to the other levels that I just mentioned earlier. So what does that mean in terms of an economic slowdown? We've got GDP growth in Australia next year of about 1.5%. So we would describe that as a soft landing. Now, certain sectors are going to feel that much more. So you can already tell with the interest rate sensitive sectors, there's very few weeks when you don't pick up the Financial Review and read about a construction company that's going bust in either Victoria or New South Wales. So certainly those sectors are going to feel it much more than other sectors. We will see an economic growth slowdown, but it is not necessarily bad news for corporate debt and company earnings and tax revenue. So that's the sort of the top-down view. Now, let me just talk about some of the yield opportunities that are available for investors, and that's what you see on screen here. So firstly, the little dotted line at the bottom, those were government bond yields for various tenors, 18 months ago. And then the solid black line is effectively the government yield curve closer to today. And then you've got a whole bunch of corporate debt. So you can see examples there like, You can see Commonwealth Bank senior debt, Suncorp, what we call AAA covered bonds. So these are the highest credit quality assets that you can buy in the bond market within corporate debt. Vicinity Centres, which for those of you who are familiar, owns Chadstone Shopping Centre and a bunch of other retail assets. Barangaroo Towers, for those who are in Sydney, would certainly recognise that. Melbourne Airport, Monash University, and I can add a whole bunch of really good household names that are now yielding between 5 and 7%, depending on the credit quality and depending on where they are in the capital structure. Now, just buying yield for yield's sake is not as straightforward as that. I think through my investing career, I've seen a number of high-profile, good quality companies in Australia effectively default. The most recent one being Virgin Airlines or Virgin Australia, during the pandemic. So it's very important to do that groundwork and the due diligence on which of these companies will prevail for the macroeconomic environment that we're painting. And the macroeconomic environment that we are painting is a slower growth world, at least over the next 6 to 12 months. Something a bit more specific to Australia is a couple of things. One, the government and the Reserve Bank was successful in attracting homeowners to borrow a vast amount of money in fixed rate last year and the year before. So there's about $500 billion of mortgages that will reprice from fixed rate to variable rate next year, much of that in Q2 and Q3. And so we don't know what the fallout of that will be. So we need to be mindful of which industries are going to perform well and which ones are not going to be performing as well. The second thing is, in a rising rate, higher inflation environment, there are some industries that don't perform as well. So if we just move back one slide, this is a way we think about positioning portfolios. So firstly, on the left-hand side are everything that we like. So to begin with, we're looking for cash flows that are much more certain, even in a rising rate, higher inflation environment. And that are the consumer staples, core financial infrastructure, especially at the senior end, if we think about our major banks. Universities, as you all know, they had a bit of a tough time during the pandemic, especially as that international revenue dropped away. If you have a look at international student enrollments that are already occurred for next year, they've really gone right back to pre-COVID levels. So you've got Monash University, University of Melbourne, University of Tasmania. Core financial infrastructure that we all need, for example, for this call, NBN company, National Affordable Housing. REITs is a really interesting area and quite a topical area at the moment. So as you know, capitalization rates really drive property trust returns and valuations. For our part, if we can focus on those lowly geared REITs where you've got gearing between 10 and 20%, you can actually have valuations fall quite a bit. And as a senior secured lender, you're in a very safe position. Whereas if you've got REITs or property trusts that are 40, 50% geared, that's when you get into the trouble of when there's a cap rate rising and valuation decline, you suddenly end up with 60, 65% gearing. And often a lot of those companies or property trusts that fall from investment grade to sub-investment grade. And then, of course, those areas that have got inflation protected cash flows. So toll roads, seaports like Port of Melbourne, Port of Brisbane, the airports, and then some of those financials that Manisha mentioned earlier, those global financials. On the rate sensitive side, this is probably where we're a bit more cautious. Now, it's not necessarily because they're bad assets, but they have particular reasons why they may not perform as well over the next 12 months. So lower quality residential mortgage-backed securities. So this is where I come back to, we don't know where unemployment might end up in 12 months' time, but let's say we do get back to 6.5 or 7%, and you get a bunch of mortgages that are rolling off a 2% interest rate or 2.5% interest rate and then repricing at 6%. The combination of unemployment plus higher costs could be actually quite damaging for those. Now, that's not to say that high quality mortgage-backed securities are dangerous at all. In fact, they're great assets. But we think we're going to get better returns from everything on the left-hand side than the right-hand side. consumer discretionary. Qantas is enjoying really their time in the sun at the moment. You would have all seen the profit results. But fast forward 12 to 24 to 36 months, once we've all jumped on a plane and gone on our first holiday after COVID, things could look quite different. And then you've got major bank hybrids, for example. Today, arguably, from a relative value perspective, they're the least attractive valued asset in our market. And then those areas that are significantly challenged from an ESG perspective. So think about our insurers and the general insurers. Now, these are some names that we've invested in for a long period of time. We know their management, very competent management, but they've just been really hard done by the floods, hail damage, and of course, bushfires prior to that. They've had 3 or 4 years of really tough times. The social license to operate, you will know in New South Wales, the loss of the Star Casino license. Certainly the likes of Crown, Tabcorp are increasingly facing an uphill battle in terms of that social license to operate. And then the stranded asset risk towards the bottom. So I guess what I'm sharing here is that we very much like high quality credit. When I say high quality, I mean AAA rated and AA rated, and to an extent single A rated corporate debt. But we need to look at it from the lens of the environment we're going to be in the next 12 months, as opposed to the environment of the last 12 or 24 months, which were really supportive from a central bank perspective.
Okay, thanks, Jay. That was great. Really appreciate that. What I might do now is I might bring Rebecca back in. Rebecca does play quite a key role in terms of, as our investment manager on the managed portfolios, in terms of portfolio construction. So Rebecca, can you maybe provide a high-level summary of how the portfolios are positioned in the current market?
Yeah, certainly, Michael. Look, without willing to repeat what I know we've all been sort of singing from the same hymn sheet, Mercer does 2 sort of roles effectively, right? The very first is what you're sort of looking at the moment, which is what we classify as a dynamic asset allocation view. Dynamic for us is really a sort of 12-month forward-looking view. It's not meant to be tactical, right? So we're not trying to time markets, but what we are trying to do is make sure that the portfolio overall is broadly positioned for the environment where we see ourselves heading into. The last 12 to 18 months has obviously been particularly challenging. We're seeing sort of this paradigm shift, but we have to deal with, the effects on valuations. I think what you'll notice most clearly from this chart in front of you. So firstly, just to explain, the white sort of signal or line is effectively where we're currently positioned. We look at it on a quarterly basis, and the black is sort of, where we were a quarter ago. The biggest thing that I think you can see is that almost the majority of all asset classes were in neutral. And what that means is that we have neither a great deal of conviction and or also the valuation changes and things that we're seeing are still not at a position that we want to sort of significantly go overweight or underweight various asset classes, right? And this comes back to the point that we all have been talking about. Yes, we agree inflation is around, how sticky it is, how recessionary things will be. We are also heading into the Christmas period, the summer period from an Australian dollar investor. We also have geopolitical tensions that are sitting on the sideline, which can and may, deliver a sort of a shock to the system that suddenly sends, markets spiraling one way or the other again. We can already see the market is generally reacting, to very little news. Effectively, if we get anything on, inflationary pressures or interest rate movements, the market sort of seems to swing about. So effectively at that level, what we have been doing, is building up cash in the portfolio. And this probably comes back to Jay's earlier point. And I know, Manusha, you also touched on it, right? That, suddenly, your starting point in fixed interest is that you're actually getting a return, right? Which is vastly different to where we were 18 months ago. So to deliver a return, I don't need to do an awful lot in fixed income at the moment, in the sense that you can hold some cash and you know you're going to pick up a return. Cash is also one of your best defensive assets, and it's also one of your most inflationary protection assets, right? Particularly when we're dealing with this sort of scenario of, is it going to be a soft landing? Is it going to be a hard landing? What we can also see is the disconnect and the lack of synchronized ways that the geographies, certain regions are coming out of the sort of pressures that we're under. So Faye, if you just want to turn to the next slide, sorry. I think, to reiterate the point, where we're seeing the opportunities, and this is what we've been working on in the portfolio, is around that sort of credit sort of side of things, and overall Australian bonds tend to look about the same or sort of slightly more attractive than global. And that's purely just due to the fact that there potentially is still some upside surprises to our inflationary numbers that are going to come out. And so sort of positioning it. I think it's important, though, more importantly, in Faye, if you could turn to the one with the managers, it's more relevant. This is how we think about it, right? So when we're actually building a portfolio, we are very much reliant on the expertise of the managers themselves. Jay touched on it, that you can't just hold a fixed interest investment and put it in the bottom drawer and forget about it, right? So we very much rely on our managers to understand the differences in different sectors and play that out for us, and we look for bandwidth in it. So you can see that what we're doing is we're looking at each of the, particularly the fixed interest market sort of managers, as to where do they play and how we classify them. So one of the things that we have done most recently is reduce the absolute return exposure or relative value, and that was so that we could increase allocations towards sort of that credit, the global and also the domestic, and also sort of cash. So you can start to see that come to the table. The next slide gives you a little bit of a sort of, insight. I mean, and this is to Michael's point before. Each of these webinars is about, starting to meet the managers a little bit more, get to understand them. They all have a distinct role to play, right, in the portfolio. So what we're looking for is, essentially, we don't want, PIMCO along with, Franklin Templeton, all necessarily holding the same view at the same time and playing in all the same markets. So it is about trying to bring diversification to the portfolio. It is about trying to play to the manager's key strengths. Each of the managers will, have an expertise or a background that they do better in than others, and so that's where we try and sort of position the portfolio. And that's, in essence, what we've been doing. We've been also, looking at the sort of passive exposure to make sure that it doesn't get too overweight, purely because whilst it tends to be a low cost and very efficient way to diversify, when you go through these sort of extreme sort of volatilities and paradigm shifts, you sometimes do need a little bit more active management in there. So that's one area that, Michael and I have been making sure doesn't get too dominant in the portfolio, but is also still there, providing that low cost efficiency sort of way to play that sort of Australian fixed interest universe. So that's particularly the focus that we've looked at in regards to the fixed interest. I mean, I know, Jay, you touched on it. We do have to think of the broader aspect, and I think that was highlighted when we looked at sort of the DAA dials. You can see that we're clearly not rushing back into equity markets. We are very conscious of some of the interest rate movement or inflationary surprises, so to speak, if we call them surprises, that are not far away as we go into that inflation, that sort of Christmas holiday sort of period. We do expect the market volatility in the short term to still persist. I think for all of us that have played in markets for a long time, December is never a good month to be deploying an awful lot of assets. And then we have what's called the January effect. So this is where, you know, it's a welcome relief in some respects that we now are in a position where you can actually let cash sort of accumulate a little bit in the portfolio and know that it is actually no longer just dragging performance down. It's actually adding to performance, and it's also giving you some inflation protection. So, Michael, I might leave it there, and feel free to, you know, jump in if you wanted to add anything in addition to that.
No, that's great. Thanks, Rebecca. So basically, we've been slowly increasing a bit of our cash position there, and obviously been actively managing this fixed interest exposure through the last 18 months, which I think has helped dull some of the bond pain. But that's been a great insight from everyone. I have had one question come through. So any of the experts, feel free to jump in and answer. And is it accurate to say that in the past, inflation, when it's not been under control, until interest rates are at least equal to or higher than inflation? If that's correct, do you expect that to be the case with this round of inflation?
Maybe I can start, and then Jay can obviously provide his remarks as well. I think it ultimately depends. So if it's a longer term kind of inflationary expectation, like a kind of a stagflationary type of environment, then in that environment, yeah, you probably should expect kind of cash rates to get to a higher level to try to curb inflation. But in a more normal environment, I wouldn't necessarily say that cash rates necessarily need to get to the level that inflation levels are at. Ultimately, the higher cash rates, their main purpose is to just effectively dull the kind of the discretionary spending and essentially rein in some economic activity, and therefore put the pressure off inflationary expectations. So that doesn't necessarily mean that cash rates need to be you know, for example, 10% if the inflation rate is 8 or 9%. It just needs to be enough to slow down the economy, and that's actually the early signs that we have seen in the US already. You know, obviously in the US, we're talking about cash rates potentially getting to something like the 5-ish type of percent level next year. But yet, even though they're nowhere near inflation levels, which are obviously you know, closer to double digits in the US, we are still seeing some signs that the economy is cooling down, even at those kind of cash rate levels. So I think that's kind of what to expect from a cash rate perspective.
I might just add there, I mean, in terms of central bank policy and the official cash rate, you know, the central banks, if I just use the Reserve Bank of Australia as one example, I mean, they've got multiple objectives. In Australia, it is price stability, which is effectively inflation, financial stability, and full employment. So today, full employment and financial stability is not a problem, but inflation is a problem. And so obviously they're dealing with that. But if we just focus on inflation for a moment, you know, there are supply side inflation that not a lot of monetary policy tightening is going to deal with. And then there's demand driven inflation, which obviously, to Manusha's point, cash rates and tightening cash rates can deal with that. So the future solution to an inflation pulse, and in particular if it's a structural inflation pulse, for example, if we decide as a country and as a government to accelerate our journey to electrify Australia away from fossil fuels to renewable energy, as an example, that could be a government policy directive. It could be a very expensive exercise. And it could mean that we have 5 years in a row really elevated energy prices. Now, raising cash rates is not going to be able to deal with that. So the way to deal with that is through government subsidies and really the fiscal side of things. So yeah, I would suggest that an inflation pulse really depends on what type of inflation pulse it is, whether it's supply side or demand. Certainly if it's demand side, cash rates can deal with that, and higher cash rates should slow the economy and end demand down.
Okay. Well, thank you, Jay. And I'd really like to thank all of the panelists today, Rebecca, Jay, and Manusha. We really appreciate the time that you've made available for our clients. Really appreciate that. And anyone who's been watching, if you do have any questions, please do reach out, let us know, and we will make a copy of this video and presentation available to you all quite shortly. So thank you for watching, and we'll look forward to seeing you at the next one early next year.
Thank you. Bye-bye.
Thank you.